Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because schools aren't, so let's get started. So this is another Stock Market Weekly recap, guys. If you've been following us, welcome back. And if you haven't, what we do is we look at the previous week in the stock market, look at some important news stories, see how the market did, look at some individual stocks and a couple mutual funds. So let's get into it. Now, hopefully you had a great week, guys. The stock market for this week was kind of like It seems like investors are kind of just waiting to see what happens. What's going to happen, nobody knows, but we're keeping an eye out. This is for the week of November 13th, 2017. And by the way, this is our 15th recap, so I did decide for every 5 recaps, intervals of 5, we're just going to go over if we did start investing from the beginning, like for example, the beginning of the 15 weeks, we're going to look at what our return would be if we did invest in it. So at the end, after going over everything, we'll be looking at those numbers. So that should be fun, but let's go for it. Starting off with Dow Jones. Now for this week, it wasn't horrible, but it wasn't great either. You could see a bunch of drops and pops back up, and I think a lot of people are just kind of waiting to see what's going on with the tax reform. I know that the details have been released, but will it actually happen? With those exact details, we're kind of waiting to see how it pans out. But for this week, the Dow Jones was down by around 0.25%. Year to date, still looking nice at 18%. And we're still above the 23,000 mark. Now, I also wanted to decide, guys, that I'm going to give you the main indexes first. So the Dow Jones, like we normally look at, that's the top 30 companies. I'll be showing you the S&P 500 right now. And then we'll look at the NASDAQ. That's more tech related, like tech stocks. So this is the S&P 500 index. For this week, it was down, just like the Dow, similar, down 0.13%. But for this year, still looking really strong at 15%. Now this next one is the one that we usually look at. It's the same idea of the S&P 500, however, it's an ETF version. But I think I'm going to be focusing on like the actual index of the S&P 500 versus the ETF. But anyhow, since we normally look at this, they are at 257.86. But for this week, again, very similar to the S&P 500 regular index because it basically is the same. But for this week, fairly flat. And the new index that we're looking at is the NASDAQ. This is tech-related stocks, guys, but they were up pretty good amount of 0.47%, year to date 26%. So with these tech stocks, definitely more volatile, and some of the things that we normally look at, for example, like Facebook, Google, Amazon, so all those are in there. Right, so those were the indexes that I'm regularly going to go over from now on. And the one main thing that I was really focused on for this week was GE, General Electric. You could see they are just getting slammed for this week, for this year, for just, oh my goodness. So, you could see on Monday, well, first of all, everyone kind of knows GE, but they're a conglomerate, they're considered. So they have a bunch of different divisions. They used to have like a bank sector. A bunch of people know them for their appliances. They are in aviation, energy sector. So they have a bunch of different things going on. But you can see on Monday, dropped 7%. Tuesday dropped even more, over 5%, close to 6%. So overall this week was over 11% drop. And you could see on the year to date, toward the top right a little bit, but they are down over 40%. Now this was huge, guys, just because GE is such a huge company. They are in the Dow Jones, and they are doing the worst. They're the worst company performing in the Dow Jones. Now what happened with them this week is they slashed their dividend in half. So people investing in them, obviously the main part why to invest in them is their dividend. They were giving over a 3% yield, I think it was, and they cut that in half. Now, good performers that have dividends, they usually never or try to never cut their dividends because obviously that's not a bad thing for them. So usually companies increase their dividend every single year. However, GE slashed their dividend twice in the past decade. The first time was during the Great Recession in 2008. They needed some cash, so they did slash their dividend. And that's actually when Warren Buffett gave them money or started investing in GE. Now, since the Great Recession, they did rebound, just like many companies did. But recently, actually, Warren Buffett got out of GE. He sold all of his shares in GE stock. And I think one of the main reasons is he thinks that money can be better used in probably some other company. Now, does the future of GE look bad? That really depends. GE right now is hugely restructuring. I know they're trying, just because they're a conglomerate, like I said before, they're trying to, get rid of maybe the less profitable companies and keeping the main ones that they want to focus on. So first, they did drop their dividend in 2008 and again this week. So a lot of people getting out of that. So GE is crashing. They're down over 40%. That's a crash. But should you invest for the long term, like this is definitely a dip, should you buy the dip? It depends how you want to look at it. They are restructuring the company as a whole. They have their new CEO. So things could move in the right direction, but it's really how you guys want to invest. I'm definitely going to keep an eye on them. I think it's kind of too early to see what happens. So something to think about just because they've been around forever. But let's move on to the ones that we normally look at, guys, with Apple. Apple did close at 170.15. Their stock has been kind of, especially with their recent release of their iPhone 10s. It did shoot up last week just because they finally released it. And I don't know, investors are like, oh, it's not doing as good as we thought, or, all that type of stuff. But I think for the long term, Apple is going to do just fine, especially with the holiday seasons coming out. But they were down over 2.5%. Now, next stock in the lineup is Disney. They closed at 103.44. This week, they were down around 1.25%. Year to date, they still are in the negative. Last week, they were up a bit, but they are kind of going back down. I'm still believing in their rebound just because they are Disney. I do have another video going over possibly to buy them for next year. So if you're interested, I'll leave a link in the description, actually. Now, in that video, I have been talking about their new streaming for the next year or two, going into Star Wars and stuff like that. But I do still believe that they will rebound, so I think Disney, especially for the long term, would be just fine. Moving right along to our tech plays of first Facebook. Facebook did okay for this week, 0.3%, at 179 even. And of course, year to date is destroying it, over 50% solid. And next tech play, Google. Not a good week. They were down 0.87%. But year to date still over the 30. Now, honestly, guys, if stocks move like kind of under 1% or even under 2%, to me, that's not even like a huge deal. Definitely looking at the long term. So small moves throughout weeks isn't a huge deal. Moving on to the food industry of Starbucks. They closed at 56.93. This week, slightly down 0.19%. And of course, the last guy that we usually look at is the mutual fund, Fidelity Contra Fund. You could see that they closed at 126.96. The chart does show a month, but for this week, it was fairly flat actually. So those were the normal stocks that we usually look at, guys. I wanted to hurry up and get into the returns of what we would have gotten if we did invest in these guys 15 weeks ago, because this is recap number 15. Going pretty strong with this actually. I'm liking this every week. So let's start looking at Apple. They are up 8.8% since 15 weeks ago. That's really good actually. With Disney, down of 3.95%. Next, Facebook, they are up 5.5%, so not too bad. Next would be Google. Google's looking really good at a 9.82%. Then we have Starbucks. Starbucks is 2.69%, so not crazy, but still pretty good. Now let's look at the funds that we'll normally look at, which is S&P 500. Spiders. They are up 4.23%, and with Fidelity Contrafund of 6.71%. So what the hell does all this mean? Well, you could see that all of them except one, Disney, so 6 out of the 7 are up since we started investing 15 weeks ago. 15 weeks ago is a decent amount of time, but we're still looking at the long term, of course. Now, what was the best performer in our little watch list that we had? Our best performer is Google. They gave us a 9.82%. The second best performer is Apple. They gave us the 8.8%. And the third best is Fidelity Contrafund at 6.7%. So you could see diversifying a bit, not having all your money in one place is a better idea. Kind of have your money spread out a bit. But you could definitely see with the index fund of S&P with that 4%, that actually outperformed a handful of them. So sometimes, especially if you don't want to do too much research, an index fund would do okay. So not a bad 15 weeks, guys. For the next one that I'm going to do this about, I'll probably do some type of thing to show you, because I know it's hard to visualize numbers sometimes. So I might do that or a chart. I'll see what I come up with. But that would be for recap 20. But overall, we're doing pretty solid. I know we're definitely going to keep an eye on what's going on with the tax reform. So if anything huge goes on with that, I'll let you guys know. I'll keep an eye on that General Electric, see what the hell is going on with that as well. But if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. And don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because not many people do. So thank you so much for watching, and I'll see you in the next one.